So, some not so key features. A bank levy. I can't work out, because I'm too stupid, whether banks will benefit more from the reduction in corporation tax than they have to pay in the levy. But I suspect it's a close-run thing. But the bank levy, they say, will raise a few £billion. Initially, it's going to be at 0.04% on the bank's balance sheet value, rising to 0.07%. Few things there that you can't possibly be interested in unless you're a foster or a carer. There was pages and pages of blurb about fosters and carers. Furnished holiday lettings were to be abolished because they were held to be incompatible with our EU treaty obligations. They are now going to continue, and we are told will be fully compliant with our EU treaty obligations, which means, in English, if you have a holiday home in an EU state, Spain, France, ... Slovenia, wherever, you let it under the right terms and make a loss, you can offset that loss against your income. But more crucially, if you sell it, you can claim capital gains tax rollover relief. That is a very, very interesting development. Getting capital gains tax rollover relief on what is intrinsically an investment type asset and a holiday type asset is interesting indeed. Some changes to enforcement powers. We get these all the time. Every announcement, there's always more changes to enforcement powers. These look particularly nasty, I have to say, because they are addressed at quarterly type returns that are relevant for indirect tax purposes. What does that mean in English? VAT returns. And returns to do with, I don't know, insurance premium tax and aggregates levy and all that lot. Now, if you get your VAT return wrong or if it is late, you will be penalised at increasingly large amounts. So not something to do lightly, I observe. So anyway, various other measures. So here we go. We are now on the run-in. We have 15 minutes to go, and here are your planning points. Well, planning point number one. That's not a planning point, you say. That is just stating the obvious. So, okay, there's only 11 planning points then. But income tax is high. Hasn't gone much higher because of yesterday. Hasn't gone higher at all because of yesterday. It was high already. Didn't have to go higher. It was already high. Corporation tax, though, has come down. Was lower, is now getting much lower. Surely that leads to some interesting opportunities. So let's think about those, and let's think about them very carefully. So interesting opportunity number one. If you have a trade or a business, I have a client, let's personalise it. Let's make some really pithy, to-the-point examples out of this. I have a client who is very rich and has a personal property portfolio which is throwing off rental income of about $150,000 a year. So it's quite valuable, quite worth having, but he's got all sorts of other income, and he does not like the idea of paying 50% income tax on this rental income, because he doesn't really need to go and spend it. What he really wants to do is reinvest it. What's the answer? Well, the answer is pretty simple. He can incorporate his property investment business. There is a relief from capital gains tax for doing this. It's sort of encouraged. It doesn't have to be a trade, it can be a business, and a business can be an investment business. So he can transfer his properties into a company in exchange for shares in that company without triggering a capital gains tax liability. Going forward, the properties have been acquired by the company at their market value. They're pregnant with gain at the moment. When the company gets them, they're no longer pregnant with gain. What's pregnant with gain is the shares in the company he gets. But he's not worried about that because we have other plans for that. So we've now got a company owning properties which are no longer pregnant with gain at the company level. The company is going to receive the rent and pay tax at, we thought 21%, now it looks like it'll be 20%, which compares very favourably with his 50%. And he is relatively happy. He can roll up his income in that structure perfectly nicely. What about stamp duty land tax, you shout? We believe that if you transfer properties to a company, there is a market value charge for stamp duty land tax purposes. Surely you're not going to trigger a 4% SDLT charge. That would be ridiculous, would? Well, no, I'm not, because happily, he owns these properties jointly with his wife. That is a property partnership business. And if a partnership transfers assets either to a partner or someone connected with a partner, there is an exemption from stamp duty land tax. So fantastic. We get within the stamp duty land tax exemption, we get the assets into the company without triggering capital gains tax, and going forward we roll up our income at much lower rates. Perfect, we'll do it. That's a nice easy one. If you've got that situation, think about it. Trades, well, trades is sort of a bit easier. If you were a sole trader and you were making profits of 150, 200, 300,000 a year, your income tax bill would be eye-wateringly large, and you could at least ameliorate that by putting it into a company. Whether, if you draw all the income out, if you say, well, I need the income though, it's my job, and it makes 300,000 a year, but I then spend 301,000 a year. I've got to get my hands on the money. It wouldn't really do you any good. You wouldn't really get very much further forward. You would make a bit of a saving on national insurance contributions, because on your self-employed profits, you would pay Class 2 and Class 4 national insurance contributions. Class 2 doesn't count very much, £2.50 a week or something, but Class 4 is going up to 9% on the first chunk. So you could avoid that. You would make a modest national insurance saving, because within the company, you could accrue your profits in the company, strip it out by way of dividend. At a tax level, you would be roughly exactly where you started, but you'd have avoided the national insurance contributions. So it might be worth thinking about. It might be worth thinking about. So a couple of examples about that. If I can just skip to the bottom point, supposing you're not a sole trader, supposing you're operating through a partnership structure or an LLP structure, what can you do there? That's a little bit more difficult, possibly, because if you do incorporate the whole business, you're then going to have to wrestle with how you are going to get your hands on the profits to spend. Are you going to strip dividends? Are you going to pay salaries? If you pay salaries, that would be a disaster. The company is likely to be large. If you're a large professional partnership, your company isn't going to pay corporation tax at small company rates because it's going to be too big to do that. It's going to pay tax at 28%, all right, coming down to 27, 26, 25, 24%. So the rate's coming down, but maybe you don't want to do that. But why not introduce a company as a partner of the partnership and give it something to do? Like be the staff partner, perhaps. And then at the end of the year, congratulate it on how fabulously it's done in this regard and give it a profit share. That profit share, you can then accumulate profits within your partnership structure at corporate rates, 21% maybe, 20% maybe. And what do you do with it? Well, you replace your partner's capital, which is human being capital that real people have put in, either by borrowing or by begging or by stealing or by just not drawing their profits out. You replace that with corporate profits, which have been taxed only at 20%. So human beings draw money out. They're not taxed on what they draw out, they're only taxed on the profit share they're allocated. And the profit share that's diverted to the company saves them tax at 51%. My God, 51%, and suffers tax at the company at 20%. So that's a good idea.